Good morning. Today is Wednesday, April 6th. We have a good one for you today. A lot to talk about, especially a lot of macro things to talk about as we get ready for the macro presentation on Tuesday. We're going to jump right into it with Spirit Airlines. They were the subject of an acquisition target by Frontier Airlines as they tried to cobble together two of the budget airlines in the United States. Now they are the subject of the acquisition interest by JetBlue. JetBlue yesterday proposed to buy Spirit for $3.6 billion. That's $33 a share in cash. That tops an offer from Frontier that was to buy the company for $2.9 billion. I think the deal from JetBlue especially, will be difficult to get through given the current administration. We talked a little bit about the trust buster there in the administration who's at the DOJ now, who's his posters of Theodore Roosevelt on his wall, talks about breaking up Standard Oil, and he really sees as his purpose to break up monopolies and increase competition. So I think that this JetBlue Spirit deal will be tough to get through. And I actually think that Spirit will probably come back and say, we need more money. It's at a nice premium to the Frontier deal, but it's right on the edge given the increased risk, in my opinion. So I think that they'll try to sweeten the deal just a little bit, or certainly create more of a breakup fee in case the deal does not go through. We also got news yesterday, and it's going to be announced later this week, that they will extend the pause in student loan payments. This has been done 6 times since the beginning of the pandemic. Payments were supposed to restart in May. Now they're going to be postponed through August 31st. So they were expected to resume in May. Now, if you have a federal student loan, you don't need to make a payment through the end of August, which of course puts it right in line with making this a big time election issue. We have Americans owing $1.6 trillion in federal student loans. That's more than any other debt obligation, consumer debt obligation, other than a mortgage. So more than car loans, more than credit card debt, more than any other type of consumer debt, except for a mortgage. And I think that this will really become a hot button issue as we get close to the midterms. President Biden does want to do some student loan forgiveness, but he doesn't want to do it through executive action. He wants to do it through legislative action. The problem is they don't have the votes in the legislative body to forgive student loans. And that's what they want to do. The chief of staff, Biden's chief of staff, Ron Klain, said, the question on whether or not there's some executive action on student debt forgiveness when the payments resume is a decision we're going to take before the payments resume. So there's been talks about potentially forgiving some student loans in one of the COVID relief packages that actually passed the House. That failed in the Senate. There was a $10,000 student loan forgiveness clause in there. Chuck Schumer, the leader of the Senate, and Elizabeth Warren are both pushing Biden to just take an executive action and forgive $50,000 of federal student loans for every person with that amount of money in federal student loans. So that would be a huge bargaining chip as they make their case to the American people. Everyone likes free handouts, and that could solidify some of their votes. I think that given the fact that they have been so poor in actually getting this done up to this point, I'm not sure if they can adequately make that case to the American people in September and October when this is going to become a hot button issue. Tom, any thoughts on the student loan pause? I do think that it will create a little bit more cash flow and open up some cash flow for the lower income consumer over the next 3 months.
Yeah, I think it's really a double-edged sword. On one hand, to put on my old man yelling at the clouds hat, as someone who was right out of school during the last recession or the last economic period where gas was $5 a gallon and there were no stimulus checks and there was no student loan pause, and as someone who had to actively pay student loans at the time, I'm a little unhappy about this. Where was all this when I was in this situation? I mean, Obama was there, Biden was there. Why were they not looking out for your boy back in 2008, 2009? But on the other hand, I think that if they really could get some debt relief pushed through, I know being in that situation when I was in my early 20s, it would have been a huge economic windfall for me. At that point, I was paying $400 a month for student loans and probably only making after taxes like $2,000 a month. And that's a big chunk of your income, and that money can flow other places like, wealth accumulation, paying off credit cards, getting a nicer car or a car that had tags in my case. So I think it could be very beneficial to the economy should they pass something like that. Hopefully they retroactively go all the way back to the early 2000s for people paying student loans, so that I could get a little taste of that retroactively. But I think there's some definite benefits to having it pushed through. I just don't think that they have the horses to get it done. But it would be, it's an interesting pipe dream, right?
Yeah, I think that if they do it through executive action, I think that's how it would have to get done. And I don't know if Biden has the appetite to do that. It certainly would be a big chip, though. If he did it, there would be a lot of people who would be very grateful to Biden, who would give him their vote. I imagine if he did something like that. I do think it's interesting too, as you see home prices go up, you see a lot of people having to be helped out in terms of buying their homes. And I think that having more cash flow, especially in their 20s, could help them afford a home and kind of realize the American dream. So it's tough. I think there are a whole lot of people to blame, including the people with the student loans, but you also have the university complex. You have the ease with which you can get a federal student loan, and then you have the government kind of incentivizing it all. So I think you have a number of factors at play there.
Yeah, one thing to tag on there too is that the piece of legislation that was put forward that made it so that you couldn't be released from your student loans in bankruptcy was pushed forward by Joe Biden. So he's just cleaning up his own mess, if you ask me. But that's just an interesting piece of information.
All right, moving on, more policy. And we're really going to get stuck in on some of the economic data here right now. The big news yesterday, which really brought down the market, was Lael Brainerd. Lael Brainerd's a member of the FOMC, the Federal Open Market Committee, and she sounded the inflation alarm yesterday ahead of the Fed's minutes release today. So about 2-3 weeks after the Fed has its meeting, then they release the minutes. And at this meeting, we're looking for more color on what does it look like in terms of reducing the size of the Fed's balance sheet? What does it look like in terms of raising interest rates? And so Lael Brainerd had a speech yesterday. She's awaiting confirmation as the Fed vice chair. And interestingly, last year, she was actually more dovish than other Fed members. So she was talking about, hey, we don't need to raise interest rates so soon. Now, the chameleon has changed. She's saying there's a paramount importance to get inflation down. She says the committee will continue tightening monetary policy methodically through a series of interest rate increases. She says that they're looking to start reducing the balance sheet at a rapid pace as soon as our May meeting. Tom, there's some interesting word choice used in these comments, and I think it's certainly more hawkish than what we've heard previously. And I'll just put it to you. Do you think the market was right to turn tail after Brainerd's comments yesterday?
I'm not certain that they were right to, but I think it's a logical reaction. The situation has changed quite a bit. The word choice is so paramount. Series means, in essence, that they're going to do it consistently, right? Because Jay Powell all along the way has said, we're going to take it one step at a time, and we're not going to lock into any sort of pattern or set of interest rate hikes. And, now you got Lael Brainerd, who essentially is going to be the second in command of the Fed, saying the word series, which I think is not an accident. They write these speeches ahead of time. So I think that was a signal there, either from her in terms of her mindset, or in terms of the Fed in terms of their mindset, which we'll find out about this afternoon, that we're probably going to be in for the long haul on rate hikes. My expectation is we'll probably get a double hike at least once, if not twice in a row. I think things are changing, though, and we'll talk about that a little bit with the economic data at the back end of the call. But I think that for sure we're going to get for sometime in the next 3 or 4 months. And then the piece on the rapid pace of the unwinding of the balance sheet. I can tell you that nothing moves rapidly in bonds. You're always waiting on money to come due. You're always waiting on a coupon, and it never hits at the time you want it to. And that's why you've got to be real careful with your laddering. And so, initially, they're saying, hey, we're just going to kind of let this stuff run off. We're going to let the interest run off. We're going to let the principal run off. But that's not a rapid pace. That's every 15 days if you're lucky. So a rapid pace to me would indicate that they're probably going to begin selling. And I think that's the main takeaway we're looking for from these Fed minutes is, are they going to acknowledge that selling bonds from the balance sheet in order to increase the level of tightening is really going to be the takeaway. And if that news comes out, I think we probably see a little bit of volatility towards the second half of the day. I mean, we saw interest rates move really counter to how they have been moving all year. Yesterday afternoon, we saw the 10-year went from a 240 to a 262, so the highest point in the year, while the 2-year, which we've been just getting crushed by, because theoretically, if you want to be inoculated against interest rates, you want to have short bonds, but short bonds have been gotten hit the hardest. Well, that was opposite yesterday. 2-year was up a little bit, about 1 basis point, and the 10-year was up 22. So we went from an inverted yield curve to suddenly we've got 10 basis points of spread between the twos and the tens, which is a steepening move, which is kind of the opposite of what we've seen. And for performance in bonds, that's going to be very beneficial. Not only that, but now you can start to see a little bit of weakness in longer bonds, which gives us opportunities in areas we haven't had so far this year. And so it's a little bit of a counter move to what we've seen. It's beneficial to the bonds that we own. And beneficial to the bonds that we'd like to buy, but it definitely was an interesting move. And it's, I think it indicates that rates, particularly on the long end, should the Fed start unwinding the balance sheet, could be moving up, and that maybe perhaps we'll get a little bit of relief on the short end going forward with these moves.
Yeah, I think that's the play. I think that you saw yesterday, the Brainerd said two things. One is that there's going to be a series of interest rate hikes. The market is already pricing that in. The market expects 9 hikes this year. 9. We've had 1. Secondly, she said that there's going to be a rapid decrease in the Fed's balance sheet. That is new. And so the rapid decrease in the Fed's balance sheet, that's going to be longer dated maturities. So that's going to be more your 5, 10-year mortgages, your 30-year mortgages, your mortgage-backed securities. And that's why we're seeing mortgage-backed securities just blow out. Mortgage rates are over 5%. On the other side, the rate increases, everyone already knew that wasn't going to change a whole lot. And that's why we're seeing that steepening, because what Brainerd said yesterday changed the thinking at the long end of the curve, but it didn't change the thinking at the front end of the curve. Bottom line, though, Fed is going to be extremely hawkish, and seem like they're almost panicking about what inflation is doing. Moving on to the economic data, and then we'll circle back and kind of close the loop on this. ISM services report came out yesterday. We're seeing a continued shift from goods to services. The services headline actually accelerated from February. That was up to 58.3. It was 56.5 last month, so up 1.8 points. Manufacturing fell to 57.1. That was down from 58.6, so a drop of 1.5 points. That makes sense. Manufacturing is ground zero for higher energy prices, which again peaked on March 8th, but we're still a major factor in that March manufacturing report. And then services was still reopening from COVID. So you're seeing a little bit of a shift there. Employment in services really picked up. That's in growth territory now. We're up to 54. That was a really disappointing 48.5 in February. New orders were up as well. And then a couple of the anecdotes said employment has improved as COVID-19 cases are declining. And they say that restaurant sales have improved since Valentine's Day, with mask and vaccine verification mandates being dropped. They do say that energy costs are skyrocketing in construction services. And one thing that we'll talk about at the macro presentation is that companies are taking a more cautious approach, especially related to planned capital expenditures. And I do think that that's something that we need to continue to watch. So that's on the ISM services report from yesterday. We're also seeing some analysts cut estimates at various retailers. Dell and HP were cut at Goldman and Morgan Stanley due to moderating demand among low-end consumers. VF Corp, the maker of Vans shoes, Ralph Lauren and TJX TJ Maxx were all downgraded due to labor inflation and mounting cost pressures. They also say that if there is a slowdown in the apparel space, mid-tier players like Ralph Lauren are most at risk. We're seeing this a little bit in the retail data, but it's not extreme. According to spend trend data, which gives you a pretty quick estimate of where retail sales were for the prior month, in March, you had total retail on a 3-year compounded basis down 1.72%. That's down from a growth of 1.75% the previous month. So we definitely see some significant deceleration in retail, but there are obviously factors. It's been a little bit of cooler March than we've had historically. And then also we've had the war in Ukraine, which has really changed things, and energy prices have obviously shocked the system a little bit. So we have seen a bit of a decline in retail. The question is this noise, or is this a sign of things to come, or something seriously changed? And I think time will have to tell on that. And we don't want to jump to a conclusion, but it's definitely something that we'll watch. The biggest concern for me right now is that we're seeing freight costs come down. Freight costs are down 20% in 2 weeks in terms of trucking costs. You have oil prices that are down 20% since the high. You have used car prices falling fairly dramatically. And now you have potential declines in demand, especially at the low-end consumer. My concern is that the Fed is going to aggressively hike rates, be too hawkish, and really hurt the economy. You have core inflation that's expected to decelerate on a month-over-month basis in the month of March, and then further in the month of April. And the Fed is hiking into that. They should have been hiking as inflation was going up, not as it's coming down. And my concern is that you could be setting up for a Fed policy mistake, especially if people like Brainerd or Powell are being dogmatic in that they have this pre-programmed series of interest rates coming. So I would be a little bit concerned about that. I'm hopeful that they're going to make the right decision, but they also need to make the right decision. And that's something that we can't make for them. Tom, what are your thoughts on all this?
Yeah, I tend to agree. I mean, if you go back and listen to some of our calls from call it July, August of last year, the table was set for beginning tapering and raising rates then, right? We knew inflation was on the rise. We knew we needed to get it done. I think a little bit of it, the delay and the ultimate pause there that could result from it, had to do with Jay Powell trying to maintain his position, get through the nomination, and then start doing the dirty work, which is maybe perhaps more of a flaw in the system of how we appoint the Fed chief versus how everything is run. But I think that played into it a lot more than really making sound economic decisions. But I think that, to the point I made earlier, I think that we're going to see inflation start to really fall in the second half of this year. And at that point, the Fed needs to say, we might need to put a pause on this thing. We've seen it happen a few times in the past where they've said, hey, maybe we've overdone it. And I think this is a point where they need to be less concerned about how telegraphed all their moves are, which is something that is really a bastion of the Janet Yellen era, which is that we're not going to do anything without you guys knowing about it 6 months ahead of time. I think that the Fed needs to say, we're not going to pre-plan all these hikes. We're not going to say we're definitely going to do all of them. If the situation changes, they need to be nimble and be attentive to that. And Jay Powell has said that they were going to be nimble, but this communication from Lyle Brainerd is very much flying in the face of that. And that does concern me a bit. A hard landing is going to be tough on the economy if we just get, way too many hikes, because ultimately what would happen is we'd have to swing back the other way and we'd be heading into QE5 or QE6, which would, of course, put interest rates super low and cause all the problems that occur with low interest rates, which we've been dealing with all the way back to 2009. And so, it's they got to thread the needle here, and it's a very small needle, and there's a lot of moving parts. And so it really kind of comes down to, are they going to be attentive to all of the economic data that's available to them, or are they just going to be flying by the seat of their pants? And I would prefer that they be attentive to all of the information that's available.
Thanks, Tom. Yep, the title for the macro presentation is The Narrow Gate, and it's titled that precisely because of the Fed's what the Fed has to do. So with that, we went a little bit long today. Appreciate you sticking with us. We'll be right back here tomorrow morning and digest the minutes and all the news at that time. Have a great day, and we'll see you tomorrow.